In this video, traders, we're going to look at when it sometimes pays to actually wait for the breakout to occur before you actually get involved with the trade. Stay tuned. Hey guys, thank you very much for joining me. Okay, so breakout type trades. Some of you know who've been around a while, and those of you new to the channel, by the way, welcome. Appreciate having you on board. Appreciate your subscription, your support. Those of you around a while, you know that I sometimes am a little bit apprehensive about breakout trades. They're not my favorite thing in the world. I prefer to be positioned, if I can, and be waiting and be on board for the breakout, because I just know that very often we get these failures, we get these fake outs, and I prefer actually trading the fake out type trade than I do the break. But I recognize, under certain conditions, when we've got that momentum, when we've got a good persistence of trend, breakouts work fine. I know that, but I just like, preferably if I can be, it's not always the case, and we'll talk of those in a second, I just prefer to be already positioned for the break. I just feel like it puts me in a more powerful position. Sometimes I'll scale some off into the break and then let some run on. And yes, that does mean that I'm limited sometimes in getting the real big juicy trends, but that's not really my speciality. If I'm honest, I'm not really a trend trader as such. I don't know how to get the really big trends. I'm after that momentum, I'm after that exhaustion, I'm after that mean reversion type thing. So that's probably why I'm not really a huge fan of just buying breakouts, full clip on the breakout, unless we've got certain conditions, which will be these right now. So there's certain times when it actually pays to wait for the break, because actually without the break, the trade isn't almost valid. Because sometimes you're in a trade and you're waiting for the break, and it's nice. There's no doubt about it, guys. If you're in a trade, it goes up to a level, you're like, I'm gonna hold it for the break, it breaks, it runs on and on. You just get the extra boost to your P&L, and the trade becomes, very juicy, for want of a better word. But sometimes, you don't want to take it before the break. An example of a trade that you take before the break would be like a pullback trade. Drive up, pulls back, you buy another pullback, you're looking for that break. You're sort of preempting that strike, so to speak. But sometimes the trade isn't valid until it breaks. And there's a distinct distinction between the two, I think. So these are my thoughts on that, guys. So the first thing is after a very strong, quick move. So this is if you've really had a massive run, okay, not a real persistency of trends, solid move that we're quite happy to buy a pullback on, but something that's really just ripped, like exhaustion type move that's just flown off so fast, so quick, feels like a lot of people are panicking. In that case, buying the pullback, you might be like, well, that could be exhaustion. Let me wait, and if it breaks again, then that's giving me the sign that actually there is a supply-demand imbalance and I want to get involved in it. So when you've got a really strong, aggressive, quick move, I think we should underline quick there because that's important, sort of signifying that it perhaps is liquidation, it perhaps is exhaustion, and then you want to wait for the subsequent break because there might be another level coming up, as opposed to thinking, right, it's just a supply-demand imbalance that you might get over a persistency of strength of trend. So that one is something you probably want to wait for the break for. The other one is when you're trading a trend reversal. So the trend reversal is when you've had a perhaps spike to the upside, or a multi-day move to the upside, or a multi-hour move if you're day trading. That then turns around for whatever reason, and then you start to get a move to the downside. So the market comes to the downside. Now, it doesn't pay to try and be too clever and preempt a break. Maybe sometimes it does. Trading's not black and white, guys, but if we're trading this kind of thing, you imagine that whatever time frame we're on, we're chugging up, and then we get the kind of move lower that really catches people out. Everyone thinks that trend's just so strong, everyone's buying into it, whether it's intraday or multi-week. Then it reverses. And there's not to say there aren't little trades to be taken on the way down and little opportunities, but if you're trading for a big reversal, you probably want to wait until that level's broken, purely because very often we might double bottom on these types of things, or we might stall here and kind of sit in the midpoint of the VWAP if it's intraday. Sometimes we do get that. Whereas if you imagine if that's the VWAP there, or if that's a mean or whatever, I'm not going off track too much with this video, but if we've broken through that and we break through the low, it creates a lot more urgency for people to get out or get into the trade. And so waiting for the break can mean there's a second wave, a third wave of selling that carries on and carries on and carries on. So if you're trading that for a longer term perspective, possibly waiting for the break rather than preempting it and getting caught shorting here when it wants to suck itself back to the VWAP, as it very often does if it's intraday anyway. Can be the better option. Right, the other thing is when that level is significant. So this is something if we're talking from when a level is significant, what I mean by this, guys, is that if it's significant from a fundamental perspective, so let me explain what I mean by that. So let's say that the Fed had cut at a certain level, or let's say a company's earnings had come out at a certain level, and the market had gone lower. It is a great example actually here. Let's say that this point in time here, okay, had been a level where the Fed had cut interest rates, for example. The market rallied off saying, woohoo, off we go, got a cut of interest rates. Then it reversed. The reason you would want to wait for the break on this, and I recognize it's the same as the second one, but the reason you want to break for this is because at that point, the market is valued lower than the fundamental change in news. So company earnings, say for example, came out, or Fed interest rates came out, something that was bullish for the market off it went, but then the market came lower and went through it. You're now basically saying the market's priced lower than it was before this bullish news was out. And so that really kind of puts the cat amongst the pigeons, so to speak, and that really just changes the dynamic of the market, because everyone's looking at it going, hey, it just changes how big money, I believe, are looking at it, because they're going, right, you know what, we sold into that, I know it's lower, now we've got to get out of the position, now we've got to liquidate, now we've got to do this. And so when it's a significant level, i.e. a point where news came out, as in Fed, as in economic data, as in anything to do with the company data, company earnings, that kind of thing, something significant, then waiting for the break often is better, because of the fundamental reason for that setup is now, hey, the price is lower than it was after this bullish bit of data. If price can't go higher or stay higher after this bullish bit of data for whatever market we're trading, then we're in trouble. We've got a real significant problem here in the underlying supply demand. Okay, the other thing is after a catalyst. So catalyst, when we've got something that's driving the market. Again, some kind of news item, something that's causing people to change their perceived valuation of the asset very, very quickly. Now, low market forces, we get markets going backwards and forwards. That's supply demand, and that's just normal market conditions. Something comes out sometimes that just changes a lot of people's perception of the market very, very quickly. And a great example is something like a surprise interest rate announcement, better than expected jobs numbers, better than expected earnings, some sort of court result that comes out with a company or something like that I look for. But anyway, something like that means that, hey, now I probably want to wait for the break, because again, if I'm trying to preempt it, the trade's not really valid yet. I want to wait for the break to come out after the catalyst. I want to wait for that catalyst, and then I can take a break. So if we're trying to take in this type of pullback trade, we're okay to take a break there, because the catalyst has caused that supply-demand imbalance, it's caused that drive. Then we get the pullback, and we're okay to wait rather than trying to tickle it here, because there's still a bit of no one knows what's going on. Is it going to reverse? Is it this? Is it that? And sometimes you need that extra confirmation to take the trade and take a little bit more risk on the deal. To be fair, you do have to often with breakout trades, but because you're trading based on the fact that that catalyst has caused a significant reprice in the market, you have to see maybe subsequent buying coming in on that, in my opinion. I mean, it's okay, it's fine to take the pullback from time to time, but sometimes, depending on what the situation is, everything's unique as we know, sometimes it's better to wait after you see that initial surge of momentum coming in, just piling in one way or the other, pulling back. Sometimes you've got to see the second surge to be more confident to take it, because otherwise you end up buying on this type of move. You end up buying on it because everyone's just kind of shuffling around. There's lots of liquidity drying up. There's this and that and the other. And so, you can get caught in those kind of things when there's big money flowing back and forward based on the catalyst. So sometimes waiting for the little bit of confirmation and giving up a little bit of price just to see that added little push and just to confirm that it is going to push is often the better thing to do. All right, guys, so that is sometimes pays to wait for the breakout. I know that textbooks talk about breakouts as being the holy grail, and I know in certain circumstances they're great. And I know a lot of you have contacted me and said, hey, you know what, I just focus on these, that's fine. But I know in some conditions, especially in the broader indices, the broader currencies that haven't quite got sometimes the aggression of the individual stocks, it sometimes pays to be a little bit picky when you're waiting for the breakout or taking an actual genuine breakout trade. Anyway, take care, keep your risk managed, whatever type of market you're trading, whatever type of strategy you're trading. Bye-bye.